All right, welcome to this deep dive. Today we'll be exploring The Mystery of Banking, second edition by Murray N. Rothbard.
Oh yeah, Rothbard.
It's a pretty dense book, but it really gets to the heart of how money and banking work, and particularly how prices are determined and how modern banking practices, impact inflation.
Yeah, you know what I really appreciate about Rothbard's work is that he doesn't just explain the mechanics of banking. He actually questions the legitimacy of the whole system.
Right.
So he really delves into the history of money and, challenges a lot of our assumptions about how finance should work.
So let's start with the basics. Imagine a world without money. How would we even function? How would you buy groceries?
Well, you'd be stuck in a barter economy, right? So
Yeah.
you'd be constantly trying to trade your goods or services directly for other goods and services that you need.
Right.
So let's say you're a plumber and you need to buy a loaf of bread.
Right.
You'd have to find a baker who needs their pipes fixed.
Right.
It would be incredibly inefficient.
Oh, yeah. A total nightmare.
Exactly. And that's precisely why money emerged. It solves this problem. It acts as this universal medium of exchange.
Okay.
So instead of needing to find a baker who also happens to be a plumber,
Uh-huh.
you can sell your plumbing services for money and use that money to buy the bread.
It makes things a lot easier.
Much, much easier.
So money simplifies everything.
Yeah. But here's where it gets interesting.
Ah.
We often think about money as just a tool for buying things.
Right.
But it's also subject to the same forces of supply and demand as any other good.
You mean money has a price?
Well, in a sense, yes. It's not a price in the traditional way we think about it, but it's more about its purchasing power.
Yeah.
What can a dollar actually buy?
Right.
And just like with any other good, if the supply of money increases faster than the supply of goods and services, its value goes down.
Yeah, that's what we call inflation, right?
Exactly.
When prices go up and your money buys less stuff.
That's it.
Yeah.
Rothbard's argument is that modern banking practices actually contribute to this inflationary process.
He really takes aim at fractional reserve banking, doesn't he?
He does. It's a system where banks are allowed to lend out more money than they actually have in reserves.
So they're essentially creating money out of thin air.
In a way, yes.
Wow.
It's like building a giant pyramid on a tiny base, inherently unstable.
Okay, so if they're lending out more money than they have, that's creating more money in circulation.
Right. And this can fuel economic activity in the short term.
But leads to inflation down the line.
According to Rothbard,
Yes.
He sees it as a constant dilution of the value of our money.
Okay, and this is where central banks come in, right?
Yeah, like the Federal Reserve in the U.S.
Right. They're often portrayed as this kind of stabilizing force in the economy.
Right, but Rothbard sees them as part of the problem.
Right.
They have the power to manipulate the money supply through tools like open market operations.
Wasn't that when the Fed buys government bonds?
Exactly. And when they do that, they inject new money into the system,
Oh, I see.
which increases bank reserves and fuels even more credit expansion,
Okay, so more money chasing the same amount of goods,
leading to
inflation.
inflation. That's Rothbard's argument.
So it sounds like we're kind of stuck in a system where our money is constantly losing value.
That's a key takeaway from Rothbard's analysis. But he also explores some potential solutions, ways to return to what he calls sound money.
Okay. We'll have to dive into those solutions in the next part of our deep dive.
Definitely.
This is getting really interesting. What stands out to you so far about all of this?
Well, I think what's most surprising to a lot of people is that money itself isn't inherently valuable.
Okay.
It's not like gold or something with intrinsic value.
Right.
It's really just a representation of value.
Okay.
And that value can fluctuate based on supply and demand, just like anything else.
That's a really good point. It really highlights why it's so important to understand how this whole system works,
It's not just about numbers and financial jargon.
It affects our everyday lives.
It absolutely does.
Yeah. So if we accept Rothbard's argument that, fractional reserve banking and central bank manipulation lead to inflation, what can we really do about it? Are we just along for the ride?
Rothbard would argue that no, we're not.
Mm-hmm.
He believes that a return to sound money is possible,
Okay.
even if it requires some pretty radical shifts in how we think about finance.
All right. Well, we'll have to save that discussion for the next part of our deep dive.
Looking forward to it.
Thanks for listening, everybody. We'll be back soon with more on the mystery of banking.
Okay, welcome back. So last time we were talking about Rothbard's critique of fractional reserve banking and the role of central banks. And, you mentioned that he advocates for this return to sound money.
Right.
What does that even mean?
But it's a really interesting concept. For Rothbard, sound money is a monetary system that's resistant to manipulation and that holds its value over time.
Okay, so it's like money you can trust.
Exactly. It's the opposite of what we have now, where inflation is constantly eroding the value of our savings. Right. So, I mean, he points to historical examples like the gold standard, right?
Yeah, where the value of money was tied to a tangible asset.
Mm-hmm.
And this prevented governments and central banks from just printing more money whenever they wanted.
But didn't the gold standard have its own problems?
No, it definitely wasn't perfect.
Yeah.
There were periods of deflation and economic hardship under that system.
Right. I've read about that.
Yeah, but Rothbard argues that those issues were often exaggerated and that the benefits of having a stable, predictable monetary system outweighed those drawbacks.
Okay. So what would a modern version of sound money look like?
Well, that's an interesting question.
Yeah.
Would we all have to start carrying around gold coins again?
Yeah. Are we going back to the Wild West?
Not necessarily.
Mm-hmm.
Rothbard actually envisioned a system where various forms of private money could compete,
Oh.
all backed by a tangible asset like gold.
So it's like a free market for money.
Exactly.
Oh.
He believed that competition would drive innovation and ultimately lead to a more stable and efficient financial system.
Okay. But so far we've been mainly focusing on the supply side of money.
Right. How it's created, how banks can manipulate it.
Right. What about the demand for money? What influences how much cash people actually want to hold?
Yeah, that's a really crucial part of the equation. Rothbard breaks down several factors. One is the level of production in the economy.
Okay.
When more goods and services are being produced, people naturally need more money to buy them.
That makes sense.
Think about it like when a new iPhone comes out.
Everyone wants to have the cash to buy one.
Exactly. Increased production usually leads to higher demand for money, which can actually have a deflationary effect,
Really?
at least in the short term.
That seems kind of counterintuitive.
Think about it this way. During the Industrial Revolution, when production exploded because of all those new technologies,
Uh-huh.
the demand for money often outpaced the supply,
Okay.
and that put downward pressure on prices.
Interesting.
So more stuff being made actually meant that the value of each dollar went up.
Okay, so it's not just about printing more money. It's about this balance between the supply and the demand.
Exactly.
What other factors influence the demand for money?
Well, there's also the frequency of payments.
Okay.
If you're getting paid weekly, you need less cash on hand than someone who gets paid monthly.
Right. It's like managing your own personal budget.
Exactly. And then there are clearing systems.
Okay.
These are institutions that help settle debts more efficiently. So think credit cards, electronic payment systems.
They reduce the demand for physical cash.
Precisely.
Yeah.
And this can have an inflationary effect because it frees up more money to circulate.
Okay.
But these are usually one-time adjustments, not a constant driver of inflation like the practices of fractional reserve banking.
But what about confidence in the money itself? I mean, that's got to play a role, right?
Oh, absolutely.
Yeah.
Trust is crucial,
Yeah.
especially for those fiat currencies that aren't backed by a commodity.
Right.
Think about a scenario where a government is on the verge of collapse.
Okay.
People are going to lose faith in its currency and its value is going to plummet.
We've seen that happen with hyperinflation, right?
Exactly. When people lose confidence, the demand for money crashes and you get those extreme inflationary spirals.
So trust and stability are key for a healthy monetary system.
Absolutely. It's
Hmm.
not just about the mechanics of banking,
It's about psychology
right? How people perceive and interact with money.
and expectations.
Yes. Expectations are huge. If people believe prices are going to rise in the future, they'll tend to spend their money more quickly now.
To get ahead of the curve.
Exactly. But that increased spending can actually fuel inflation in the present.
So it becomes a self-fulfilling prophecy.
Right. It's a feedback loop.
Yeah.
It's not just about how much money is out there, but what people believe will happen to the value of that money.
Okay. So we've talked about fractional reserve banking, but Rothbard also mentions this thing called loan banking.
Right.
Is that a different system?
It is. Loan banking in its purest form actually predates fractional reserve banking. It's a much simpler system.
Okay.
Banks act as intermediaries between savers and borrowers, facilitating the lending of funds that already exist.
So there's no creating money out of thin air.
Right. It's more like a matchmaking service for money. Someone deposits their savings, the bank lends that money to someone who needs a loan.
So it's more straightforward?
Yeah. But there are still risks.
Okay, like what?
Well, the primary risk is that the borrower might default,
Uh-huh.
and this could impact the bank's profitability and even its solvency.
Okay, so while it might not be inherently inflationary like fractional reserve banking,
Right.
it still carries its own set of challenges.
As every system does.
This has been helpful in understanding the different types of banking systems.
Good.
But Rothbard's book is ultimately a critique of modern banking practices. Are there any arguments in favor of these systems?
Oh, there definitely are. Proponents of fractional reserve banking often argue that it's essential for economic growth.
Okay.
They say that by expanding credit, it stimulates investment and entrepreneurship.
So creating more money leads to more economic activity.
That's the argument. And as for central banks, they're often seen as a necessary force to stabilize the financial system, prevent those panics and crashes.
So it's a trade-off then. We accept some inflation and potential instability for the possibility of greater economic growth.
That's the debate, and it's one that's still going on today.
Yeah, this deep dive is really highlighting just how complex this all is.
There are no easy answers.
Yeah.
Both sides have valid points.
It's about understanding the trade-offs and the potential consequences of different approaches.
Exactly.
Well, we'll delve further into Rothbard's proposed solutions in the final part of our deep dive.
Be sure to join us for that.
Welcome back to our final deep dive into Rothbard's The Mystery of Banking. We've covered a lot of ground, from the origins of money to the role of central banks and all the complexities of fractional reserve banking.
And we've really dug into the mechanics of how our financial system works and, the potential downsides
Yeah.
of the current system.
Right, exactly. So now it's time to explore the solutions. You mentioned earlier that Rothbard advocates for this return to sound money, but how do we actually get there from where we are now?
It's a challenge.
Ah,
Rothbard's vision is a complete separation of money and state.
okay.
He argues for a system where money is not subject to the whims of politicians or central bankers.
So no more Federal Reserve, no more printing money to fund government spending.
That's the idea. He saw those institutions as inherently prone to abuse,
Okay.
leading to, inflation and financial instability.
But wouldn't that be incredibly disruptive to the economy? I mean, our entire system is built on this.
It would be a major transition.
Yeah.
Rothbard acknowledges that,
Yeah.
but he believes that the long-term benefits of a stable, sound money system would outweigh the short-term costs.
So what are some of the specific steps he proposes?
He advocates for a return to a commodity-backed system, similar to the gold standard.
Okay.
This would mean tying the value of money to a tangible asset with inherent value.
So every dollar would be redeemable for a certain amount of gold.
It's essentially yes. This would prevent the arbitrary expansion of the money supply and impose discipline on governments and central banks.
But wouldn't that make the economy too rigid? What about the need for, flexibility to respond to economic shocks?
That's a common criticism of the gold standard. But Rothbard argues that a modern sound money system could be more flexible than the historical gold standard.
Okay. How so?
He envisions a system with competing private currencies, all backed by a commodity like gold.
Okay.
Think of it like a free market in money, where the most stable and trustworthy currencies naturally win out.
So instead of having a single government-issued currency, we'd have a variety of options to choose from.
Exactly. Competition would drive innovation and efficiency in the monetary system, just like it does in other industries.
That's a pretty radical departure from how we think about money today.
It is. But Rothbard believed that ultimately a sound money system, based on free market principles, would lead to greater economic stability and prosperity.
It's definitely a thought-provoking vision, but realistically, how likely is such a radical transformation? It's hard to say. There's definitely growing interest in alternative monetary systems, especially with the rise of cryptocurrencies.
Do you see cryptocurrencies as a potential path toward Rothbard's vision of sound money?
It's an interesting question. Some cryptocurrencies, like Bitcoin, share some similarities with Rothbard's ideas.
Okay.
They have a fixed supply, they're resistant to government control, and rely on decentralized networks.
But they also have their own challenges, right? Volatility, scalability, regulatory uncertainty.
Absolutely. Cryptocurrencies are still in their early stages of development. It remains to be seen whether they can truly fulfill the role of sound money.
So what's the takeaway for our listeners? What should they be thinking about after this deep dive into Rothbard's work?
I think the key message is to question assumptions. Don't take the current monetary system for granted. There are alternatives, even if they seem radical or far-fetched.
It's about understanding the power of money, how it's created, how it's manipulated, and how it impacts our lives. Exactly. And perhaps most importantly, it's about recognizing that we have a choice. We don't have to passively accept a system that constantly erodes our wealth and undermines economic stability.
This has been a real eye-opener. We've learned a lot about banking, the dangers of inflation, the potential for alternative monetary systems.
It's been great exploring these ideas with you.
Absolutely. And hopefully our listeners are now better equipped to navigate the world of finance.
It's a complex world out there.
It is. We encourage you to continue exploring these ideas, stay curious, and never stop questioning the systems that govern our lives. Thanks for joining us on this deep dive into the mystery of banking.
Did you get any of that?